Hello, savvy investors and real estate aficionados. It's Iggy here from Investing Iguana, ready to dive into a hot topic in the Singaporean investment landscape. Welcome to our latest episode, Singapore REITs on the Rise, analyzing DBS's bullish outlook. In this session, we're going to dissect the recent surge in Singapore's real estate investment trusts, S-REITs, and explore the optimistic forecast presented by DBS Group Research. With a background deeply rooted in financial analysis and a keen understanding of the real estate market, I will guide you through the intricacies of S-REITs and what DBS's bullish stance could mean for investors in 2024. We'll delve into the factors driving this positive trend, from market valuation to yield spreads, and dissect what this could mean for your investment portfolio. So, grab your notepad, and let's unravel the potential of Singapore's REITs in the coming year. Singapore's real estate investment trusts, S-REITs, have seen a promising rebound of approximately 7% in November and December, following a downturn in global 10-year yields. This resurgence has prompted DBS Group Research to encourage investors to consider or increase their investments in S-REITs. In their December 14th report, DBS analysts Derek Tan, Rachel Tan, Dale Lai, and Geraldine Wong highlight the potential of S-REITs in the upcoming fiscal year. They predict that with yields likely to decrease in FY 2024, these yield-sensitive assets have considerable growth potential. This optimism stems from an anticipated repositioning by dividend-focused investors attracted by S-REITs' favorable valuations of a 0.85x price-to-book value ratio, P/BV, and yield spreads widening to about 3.9%, surpassing the 10-year average of 3.3%. The report reflects on the period from the second half of FY 2022 to FY 2023, noting the significant rise in interest rates that led to a correction in asset prices. These changes varied in impact, depending on geographic location and asset type. The analysts reassure investors, based on sensitivity analyses, that approximately 90% of S-REITs are likely to remain within the Monetary Authority of Singapore's MAS gearing limit of around 45%, even after assumed reductions in book values. They further note that despite potential write-offs, S-REITs are trading at an attractive P/B ratio of 0.87x, close to below one standard deviation levels. This suggests that current valuations have likely factored in the negatives. Looking ahead to FY 2024, even with high refinancing rates factored into estimates, the projected net property income (NPI) growth is expected to be around 4.4% GR over FY 2024 to FY 2025. This growth should lead to a distribution per unit (DPU) growth of about 2.0% GR. The hotel subsector, in particular, is expected to lead this growth, driven by robust revenue per available room, RevPAR, growth and contributions from completed refurbishments and acquisitions. DBS analysts also emphasize that in the current cycle, the value of S-REITs outweighs safety, with a focus on reallocations into retail, commercial, and hospitality S-REITs. They favor industrial S-REITs for multi-year secular trends in logistics and data centers. Regarding the overall outlook, the Singapore economy is projected to grow by an improved 2.2% in FY 2024, following an estimated 0.9% growth in FY 2023. This growth should positively influence Singapore's real estate market. Based on DBS projections, S-REITs are expected to deliver an NPI growth of around 4.4%, ranging from 1.2% to 8.0% over FY 2024 to FY 2025. However, the continued rise in interest rates might impact this positive growth, with around 24% of debt expiring in FY 2024 and an expected rise in overall interest costs of up to 2.5%. The DBS team anticipates that DPU erosion will be noticeable, particularly in the first half of FY 2024, although easing rate conditions could mitigate this impact as the year progresses. So, how does DBS's bullish outlook bode for S-REITs in 2024? There are 6 interesting points to take note with regard to this. 1. The resurgence of S-REITs, Singapore Real Estate Investment Trusts, S-REITs, have seen a significant rebound of about 7% in recent months. This resurgence is particularly noteworthy given the past volatility in the market. The retreat in global 10-year yields has been a key influence on this move. The 10-year yield is a benchmark used to decide mortgage rates across the U.S. and is also a signal of investor sentiment towards the economy. When the yields retreat, it typically indicates lower interest rates, making borrowing cheaper. This can be beneficial for REITs as they often rely on external financing for operations and acquisitions. As investors, understanding the underpinnings of this rebound is crucial for making informed decisions. Factors such as the economic outlook, interest rates, and sector-specific trends can significantly impact the performance of S-REITs. For instance, the industrial S-REIT sector holds promise amid the economy's slow recovery from the effects of COVID-19. 2. Yield and valuation dynamics. One key aspect highlighted by DBS is the attractive valuation of S-REITs at a 0.85x price-to-book value ratio, P/BV, and a yield spread of around 3.9%. These figures are notably above the 10-year mean, making S-REITs an appealing option for yield-seeking investors. In 2024, as the market potentially stabilizes, these valuation metrics could play a significant role in driving investor interest. 3. Interest rate outlook and its impact. DBS has highlighted the attractive valuation of Singapore Real Estate Investment Trusts, S-REITs, at a 0.85x price-to-book value ratio, P/BV, and a yield spread of around 3.9%. The price-to-book value ratio, P/BV, is a financial ratio used to compare a company's current market price to its book value. The P/BV ratio of 0.85x indicates that S-REITs are trading at a discount to their book value 1. This could be seen as an attractive valuation, as it suggests that the market price is undervalued compared to the company's intrinsic value. The yield spread refers to the difference between the yield of S-REITs and a risk-free rate of return, typically the yield on a government bond. A yield spread of 3.9% suggests that S-REITs are offering a significantly higher yield compared to risk-free assets. This makes S-REITs an appealing option for yield-seeking investors, as they can potentially earn a higher return on their investment. These figures are notably above the 10-year mean, suggesting that S-REITs are currently undervalued compared to their historical averages. This could attract investors who believe that the market will revert to the mean over time. 4. Sector-specific opportunities and risks. The Singapore Real Estate Investment Trusts, S-REITs, market is diverse, with different subsectors experiencing varying degrees of growth. Hotel subsector. The hotel subsector within S-REITs shows promise, particularly with the robust revenue per available room, RevPAR, growth. RevPAR is a performance metric in the hotel industry that is calculated by multiplying a hotel's average daily room rate, ADR, by its occupancy rate. It gives hotel operators an idea of how well they are filling their rooms, as well as how much they are able to charge for them. The robust RevPAR growth indicates that hotels are not only filling their rooms, but also maximizing their revenue potential. Industrial subsector, on the other hand, industrial S-REITs, though less attractive valuation-wise, remain strong due to enduring trends in logistics and data centers. The growth in e-commerce and the digital economy has led to increased demand for logistics facilities and data centers. Industrial S-REITs, many of which support logistics for e-commerce and provide high-quality space for data centers, have benefited from these trends. 5. Macroeconomic factors and real estate dynamics. Singapore's economy is projected to grow at an improved rate in FY 2024. This economic growth is expected to positively impact the real estate market and consequently, Singapore Real Estate Investment Trusts, S-REITs. Economic growth often leads to increased demand for real estate as businesses expand and consumers have more income to spend on housing and goods. This increased demand can lead to higher property values and rental rates, which are beneficial for S-REITs as they typically generate income from rent and appreciate in value from property appreciation. The combination of economic growth and positive rental reversions suggests a potential for sustained growth in the S-REIT sector. As the economy grows and rental rates increase, S-REITs could see their revenues and property values rise. This could lead to higher distributions for S-REIT investors and potential capital appreciation. 6. Debt Management and DPU Outlook. Singapore Real Estate Investment Trusts, S-REITs, will indeed need to manage their debt profiles effectively, especially with a significant portion of debt expiring in FY 2024. Effective debt management is crucial for S-REITs as it can impact their financial stability and ability to generate returns for investors. This involves managing their debt maturities, refinancing needs, interest rate exposure, and maintaining an optimal capital structure. The anticipated increase in overall interest costs could indeed impact the distribution per unit, DPU, growth. Interest costs are a significant expense for S-REITs, and an increase in these costs could reduce the amount of income available for distribution to investors. However, many S-REITs have fixed-rate debt, which can help mitigate the impact of rising interest rates. And that wraps up our deep dive into the burgeoning world of Singapore's REITs, guided by DBS's bullish outlook for 2024. We've journeyed through the intricacies of this market, uncovering the potential behind the recent rebound and what it could mean for future growth. From analyzing the price-to-book value ratios to examining the impact of interest rate changes, we have traversed the landscape of opportunities and risks within the S-REIT sector. As your guide in the complex world of investment, my aim is to provide you with insights that are not just informative but actionable. Remember, in the dynamic realm of real estate investment, staying ahead means staying informed. This is Iggy from Investing Iguana, bringing you the latest and most insightful financial analyses. Stay tuned for more updates, and remember, the right knowledge is your key to successful investing. Until next time, keep analyzing and investing wisely.